Hello, my name is Mark, and I'd like to welcome you to the Right Line Trading training training video series. I really want to first congratulate you on taking this really important step in investing in what I consider to be an amazingly powerful piece of software. I'm excited to be able to explain to you today how the system works, and I'm going to start by breaking the system down indicator by indicator, carefully explaining to you the meaning of each indicator, putting each indicator together one by one, and then showing you how the system in its entirety will provide you with really amazingly powerful entry setups. So let's start off with a blank workspace that only demonstrates price action. Now here's our blank workspace. This is crude oil, and this is actually a Sunday, and the market's live. It's just moving. Actually, the market will be live in fairly shortly. And what I trade is an 8-range chart. And if we look at my settings, you'll see that I have the range is set at 8. Session template is always set at default 24/7. This means that the chart will continually plot around the clock. There won't be any session breaks. And under plot executions, I have do not plot. I do not want to see my trades on the chart. After a while, they crowd it and they complicate it. They make it more difficult for you to be able to examine price action. Now, the reason that I believe it's best to trade range bars is that we can determine the close of the range bar or estimate the close when we look at the open. If the range bar opens at 100, say, we know that it needs to go up 8 ticks to go to 100.8 to close to the upside, and close down 8 ticks for it to close to the downside. This really provides you with a strategic advantage when it comes to entering your buy stop or sell stop order if you see a particular trade entry developing. Now, the first indicator I'm going to put in is actually the Right Line Range Maker, and I'm going to show you how advantageous it is to be able to estimate the close of the price bar either to the upside or to the downside. Now I've added in the Right Line Range Maker, and the Right Line Range Maker tells us already that the estimated close of the candle to the upside is going to be 101.82, and the close to the downside is estimated at 101.66. So if we saw a potential strategy maturing, we would know exactly where to put our buy or sell stop order. Now, if the trade was going to be one that we would take long, we would be in 1 tick above the close of the candle. Right now, the candle is estimated to close at 101.82. We would be in at 101.83. If the trade strategy and trade setup told us that this was a trade that we wanted to go short, the candle is estimated to close at 101.66. We would be in 1 tick below at 101.65. Now, as the candle moves, these numbers change slightly. But all you have to do is simply work on the Superdome to slowly move your order either up or down. And to show that, let's say we're trading crude oil, and we want to take a sell If the instrument drops to 101.70, the range maker tells us it's going to close at 101.71. Well, let's take the example that's here right on the chart. Right now, the range maker tells us that this candle is going to close at 101.66. We would be in one tick below. We would put in a sell stop, 3 contracts.
Order pending.
And our order is now pending at 101.65. The market would have to come down and take our order out in order for the trade to mature appropriately. Now let's say as the market moves, the close of the candle changes slightly. Well, we're watching it. We simply click and move. Click and move. Click and move. So that we're never going to wind up with a trade entry sliding past us. We're always going to be sitting and waiting for that trade to take place. The system works extremely well on tick bars. It works well on time bars. It also works on Renko bars and volume bars. It is simply my personal bent to go with range bars because it does give me the ability to place this buy and sell stop order in before the close of the trade.
Order canceled.
Just cancel the order. Let's move the Superdome off. And now let's add our second indicator. Now the second indicator that I added is the 50-day simple moving average. And it really is a critical moving average for our right line trading strategy. Now, in order to optimize the predictive value of our setups, right line trading rules dictate that we only go long when we are above the 50-day SMA, and we only sell short when we are below the 50-day SMA. So essentially, this defines our buy-sell zone. We're going to look to take a trade to the upside when we're above the 50. We're going to look to take a trade short or to the downside when we are below it. That's really critical, and this will help to make sure that the trades that you take are successful. So now we've defined our 2 buy-sell areas. We buy above the 50 SMA, and we sell short below the 50 SMA. And now I'm going to add in the next critical indicator in which we use to evaluate market structure. Now I've added in the right line trend, and that is our moving average here. Now the right line trend is a modified 15-day moving average. It is not an exponential and it's not a simple. It's a proprietary moving average that also helps us define whether or not market structure dictates we're able to take a long trade, or market structure dictates that we're able to take a short trade. Now we already know that we need to be above the 50 in order to take a buy and below the 50 in order to take a sell. Now the other immutable part of the market structure setup that must be present in order for us to take a buy is that the right line trend, this line, must be above the 50-day SMA, and it must be green. So now let's take a look at our additional rules. I don't want to be redundant, but these are such important market structure rules that I know I'm going to be mentioning them over and over again. But we're above the 50, which is our buy zone, and we have our right line trend line, which here turns green. And now we have the OK if we get a right line entry to go long. So we have met two of the criteria which must be present in order for us to take a long trade. The RL trend must be above the 50-day SMA and must be green. So if we got a signal here, and we may have, we just don't have the other indicators present, market structure would dictate that this is an appropriate place for us to take a long trade. So the opposite must be true for a short. For a short, we must be below the 50-day simple moving average. The right line trend must be below the 50-day SMA, and it must be red. So as the right line trend line cross below the 50 here, if we got a signal to go short, we would take it because market structure would be appropriate. So we have our two major market structure definitions, two major market structure criteria, which must be met for us to take a long or a short trade. Again, to go long, we're above the 50, above the right line trend line, which is a proprietary 15-day moving average, and the right line trend line must be green. To take a short, we must be below the 50, and our proprietary right line trend line must be red. Now I've added in an additional indicator, and it's our right line pivots. The right line pivots are calculated automatically, and they're areas in the market where price action has turned previously. Well, if we look right here, and here, we can see that prices come down to this area of support, which is a trend line. It's blue, demarcating support, and turned up. Prices come down, hit the trend line, and turned up. We also have an area of pivot support here, an area of pivot resistance here. Now, what's extremely important about pivots is this. As sellers have come into the market and pushed the market down, we know that buyers took command of the market here and turned it up. Then sellers pushed it back down. Buyers took command of the market and pushed it back up. So we don't want to take a short trade into a trend line, and we don't want to take a long trade into a trend line. So an additional market structure rule of right line trading is that we do not take trades into trend lines. They're important areas that have where the market has turned previously, and we don't want to take the risk of trading into one of these because there's a chance that the market will turn there again. Now, sometimes the market will move right through a pivot and push it down lower, but the presence of the pivot makes this a higher risk trade, and what we're looking for in the right line system are the lowest risk trades possible, the trades where the probability of success is the highest. Now, I've added in two more critical indicators to help define market structure. And we need all of these indicators in order for us to determine the real low-risk entries. Now, these are simple NinjaTrader indicators. There's nothing special about it. About these, the The gold line is a 100-day simple moving average. And the silver line here is a 200-day simple moving average. I've labeled the moving averages to make them a little bit easier for you to see, because the chart's becoming a little bit more complex. And again, just like right line pivots, moving averages, again, are areas of support and resistance, and we do not want to trade into them. If we do not have room from our first target, from our entry to our first target before we hit a major moving average or a pivot, then we stay away from the trade. Now, once we have all of the indicators inserted, we're going to go over trade setups over and over again. And you're going to see how the pivots and the trend lines all help to provide with real optimal trades. So just to recap again, at the risk of being a little bit redundant, what we're looking for is price action for a long trade to be above the 50, to be above our right line trend line, which is our proprietary 15, and we don't want to have any moving average or pivot in the way to the upside. Now, we don't hit a pivot until we get all the way up here at 101.68. So there's a huge amount of space here if we had a signal to go long here for us to take a long trade. And this would be a tremendously, this would be a really nice place to take a long trade, because you can see our gold moving average, which is our 100-day SMA, actually acts as support for this candle. The candle is sitting on it, and hopefully it would launch to the upside. Now, a short would be below the 50, below the right line trend, which is heading across it in red, and we're not trading into any pivots. The first pivot is all the way down here. There'll be no problem there. The 200-day SMA is all the way down here. If we had a signal to go short here, we would be in on the trade to the downside for a real nice profit. Now, once we're moving to the downside, we have to watch carefully, because this may be an area to take profit. But we'll talk about money management towards the end of the video. Right now, we're just looking for market structure and eventually move into trade setups. Now, after 10 years of day trading the markets, the market started to move at 6 p.m. and what you're hearing is actually the system giving off signals. So if you hear an occasional ringing or trigger, hopefully just ignore it, because that's the system taking trades on other charts that are flashing on other screens. Now, after 10 years of day trading, I really came to the conclusion that it is important to have certain information on your chart, that this information helps you obtain. We're getting a lot of trading action here off of gold, and gold is flying to the downside right now. So again, I'm sorry for these bells and whistles here. If they continue to go off like this, I will I'll take the charts out. But I found that there were certain components that Okay, I've hushed up the signals on the other chart so they don't interrupt us anymore. So it became obvious to me that there were certain components that are necessary to have on your chart in order to optimize the probability of taking a successful trade. Now, the first of that is momentum. Now, momentum is based on some MACD system. There are all different kinds of inputs that are out there. There are fast inputs, there are slow inputs, but some MACD component, some formula that churns out a MACD format in which a slow moving average and a fast moving average are used, and the acceleration of the fast moving average away from the slow moving average indicates that momentum is to the upside, and the deceleration or the movement back of the fast indicator to the slow indicator indicates that momentum is now decreasing and moving to the downside. I also realized that you need some type of oscillator. The oscillator can be relative strength, it can be the CCI, it can be stochastic, but you do need some stochastic or oscillator based component indicator in your trading platform in order to help manage your trades. And more recently, in addition to the trading armamentarium we have, is now order flow. And it looks at executed buys and sells that cross the tape. Now, some platforms allow you to actually look at a footprint, the buys and sells that occur at every tick. And in fact, NinjaTrader allows you to do that. The only thing that NinjaTrader does not allow you to do is store order flow data. So there were three components that we needed on the trading chart in order to optimize the probability of getting a successful trade. The first is order flow. The second is some oscillator-based system. And the third is some momentum-based system. So in order to take all three of those, place them on the chart in a form that makes it extremely easy for you to look at and utilize, I created the three-line indicator. Now, I think the three-line indicator is one of the most unique and most powerful indicators of any trading platform available on the market today. In fact, I think that its power approaches that of some of the very expensive trading platforms that are available to the major brokerage houses, which we don't have access to. Now, the three-line indicator on the first line assesses order flow. On the second line, looks at stochastic direction. On the third line, it assesses momentum direction. So simply by looking at this single indicator and these three lines, we can make an assessment of order flow direction, stochastic direction, and momentum direction. This single indicator replaces three other indicators. Now, what makes the three-line indicator also so powerful is the fact that this indicator assimilates data from multiple time frames. Now, there's always the age-old argument of whether or not you need to trade multiple time frames and multiple charts. And obviously, if it was easy to look at multiple higher time frames, it would be advantageous to do so. Because to take a trade in the direction of the market on higher time frames is always advantageous. What the three-line indicator allows you to do is just that without having to look at multiple charts. It does the heavy lifting for you and makes these assessments for you. So when the three-line indicator is red on either order flow, stochastic, or momentum, you know that order flow is the selling predominates. On all time frames. Stochastic is moving to the downside on all time frames. And momentum is moving to the downside on all time frames. When the 3-line indicator is green, then order flow, on the order flow side, people are executing predominantly buy orders. Stochastic is moving to the upside, and momentum is moving to the upside. Now, when the 3-line is blue, and I'm going to type this out for you so you will have this visually and it'll be easy to remember. The longer term time frames are in your direction. The shorter term time frames are against you. But it is my belief that longer term time frames rule. So if the 3-line indicator is blue, your longer term time frames are telling you it's okay to go long. There's a predominance of buy executions on the longer term time frames. We let longer term time frames tell us direction on our trading chart, and so we can take a long trade. When the 3-line indicator is orange, it means that order flow, stochastic, and momentum are to the downside on the longer term time frames, up on the shorter term time frames. We let the longer term time frames rule again, and we have the green light to take a short trade. So here are our 3-line indicator rules. When we're red on all time frames, the 3-line indicator will be red when we are down on all time frames. That's an okay to go short. The 3-line indicator will be green when we're up on all time frames. Obviously, we have the okay to go long. If we're orange, we are down on longer term time frames, and we're up on the shorter term, but we have an okay to go short. And when we're blue, we're up on the longer term time frames, down on the shorter term, but we're okay to go long. So it should be very intuitive and easy after a little bit of experience and a little bit of chart time to be able to interpret the 3-line. And why don't we take a look and see what goes on with the 3-line, just evaluating the market. Now we do have, I want to take this one step further and show you this. Now this is the first signal that I have, I'm going to show you. Now when the 3-line indicator, just to make this system even simpler, when the 3-line indicator is all green or all red, it indicates such on the paint bars. Now I have elected to outline my paint bars in blue when all 3 lines on the 3-line are green, and I've elected to outline my paint bars or my candlesticks in yellow when all 3 are red. Now here is a perfect long entry. It meets all of our criteria. If you remember, we need to be above the 50-day SMA. We need to be above the 15. The 15 needs to be green, and it is green here. Even though it does turn yellow briefly after the entry, it was green at candle close, and you can see that the candle is outlined in blue, which tells you that the 3-line indicator is green on all time frames. Market structure is appropriate. We get a 3-line indicator signal. And we have a long trade, and we're in 1 tick above the close of this candle. The close is 101.04. We would begin at 101.05. It just breaks right through the trend line. And the high of the move was 31. So this was a 26 tick trade. It adhered to market structure by being above the 50, above the 15. 15 is green. We get a 3-line signal with an outline of the candlestick in blue. We're in 1 tick above, and up we go to the long side. Here's a gorgeous 3-line call to the downside. Now the 3-line goes all red here, but we base our entries on a break of the 50. We must have a broken 50-day SMA, and Steve Nissen defined, really the candlestick maven of the world, defined a break of a trend line by a 2/3 candle close below that trend line. Now the body of this candle on this candle does not close below the 50, but this one does. So we've met all of our market structure criteria. Now the 15 is not quite below the 50, but it's red and pushing down hard. If you wanted to be a little bit more conservative, you may have wanted to go in here. If you wanted to be ultra conservative, you could have taken your entry here. But this is such a wonderful market structure setup. We have the 15 red heading down. We're below the 15. We're below the 50. The close of the candle is 101.70. We would be in at 69. And based on money management strategy, I believe this is about a 100 tick trade. Now I've tried to make the assessment of the 3-line indicator as intuitive as possible and as easy as possible. And this is why I've actually created the 3-line direction on the paint bars themselves. But remember, we can still take a short trade when the 3-line is not only red but also orange. And we can still take a long trade when the 3-line is not only green but blue. This is not going to show up on your paint bars. So what you have to do is watch market structure carefully. Watch when the 50 falls below when price action falls below the 50. The 15 is pushing down hard and crossing the 50. And look down to the 3-line for indicator confirmation of what is a market structure setup that gives us the go to take a trade. And we're going to do a lot more on that later on in this video. Now I hope everybody's with me so far. I just want you to know that we're going to provide you with a tremendous amount of educational support. If there are any questions, you are welcome to call the office at any time. We're here to support you. The platform is really very intuitive and very easy to use. It does take some getting used to because you need to process it because it's processing a tremendous amount of information for multiple time frames and it's feeding it to you. And it may take a little bit of chart time for you to be able to assimilate all that easily. But trust me, if you sim this system for a few weeks, you'll really be able to trade it quite easily. Now, I've added one more indicator. Now, the top line of our 3-line assesses order flow direction. Our order flow entry indicator assesses order flow asymmetry. Now, here's the difference between order flow direction and order flow asymmetry. and what makes the order flow indicator such a powerful indicator when the signal is taken in context with market structure and all the other indicators. Let's take this signal here. Now, what happens here is the market is moving to the upside. Buyers are in control. What happens here is sellers try to take over. They try to take command of the market. And they do so unsuccessfully. But what the order flow asymmetry indicator is telling us is that most of the sellers are stuck at the bottom of the candle. They're all down here. Now, when your sellers are stuck at the bottom of the candle, and then you get this engulfing candle to the upside, and you'll see later we have an indicator that actually assesses market structure. As the market begins to move up, and you can see that you get a three-line signal right here, but the system is going to give you an entry here. I just don't have that indicator in yet. And you can see we've met market structure criteria. We're above the 50. We're above the 15 right line trend line, the modified 15. The modified 15 is green. What the order flow asymmetry signal tells us is that all these people caught at the bottom of this candle are going to get stopped out rapidly as this move starts to progress to the upside. And as these people get stopped out, it's going to help propel the market to the upside. So in assessing a trend trade, it's a powerful instrument for using in order to assess if the trend is going to continue to the upside. Now, you would have your buy stop order waiting one tick above the close of this candle. And if this candle does engulf, if the trade does mature in the manner that you would like it to, you have a tremendous trade to the long side. The entry here, the high of the candle is 101.03. You'd be in at 04. And this candle goes up to 55. This is a 51 tick trade. So just that quickly, you're up a lot of ticks. Now, order flow asymmetry indicator also is very good at calling market turns. And you can see the signal here, and the market turns to the downside. But I do not recommend we trade reversals. I am strictly a trend trader. So I do not take reversal signals, even though the order flow indicator gives us some real excellent ones. I'm going to show you how to take them, but I do not recommend you do, because there's so much money to be made, so many ticks to be garnered, simply by going with the trend, staying in the direction of the market, and not trading against the three-line indicator, but trading with the three-line indicator. And if you'll notice, if we go back to this trade here, we had the three line with us on all three lines. Order flow, momentum, and stochastic were green to the upside on all three lines. Now I wanted to show you how great the order flow indicator is at providing you with pullback entries. You can see here we have a nice trend to the upside. Flattens out here, comes green here again, and our right line trend line becomes here again, becomes green here again. order flow signal here. Whoops. I've got this right now. Now we have an order flow signal here indicating order flow asymmetry. Most people are long at the top of the candle. Now on a pullback signal like this to the modified 15, sometimes we will take these trades against the color of the 3 line, which is the nature of a pullback. What this essentially is a mini reversal trade. A mini reversal. Now we're into the major. We're staying in the direction of the major trend, but the minor trend has reversed. So we have a move up. Then we have a pullback. Now the pullback is enough to turn the 3 line on all of its time frames against the direction of the right line trend line. But as price action pulls back into it, we get an order flow signal, which is a very, very powerful signal. And this is in the right line trade playbook. And you'd be in one tick above, and up you go. The key element here is that we respect market structure always. We must be above the 50, above the 15, and the right line trend line must be green. Again, we have the same thing here. Now the right line trend line is just about to turn yellow, but at candle close we have it green. We get a very deep pullback on an order flow signal. Now remember, I recommend that we don't trade reversals. We don't take a short trade above the 50. So we are only going to go in the long direction. We get an order flow signal to the upside on a pullback to the right line trend line, which is still green, and up we go. Now we have an area of yellow which we do not trade. We never trade a yellow during the time that the right line trend line is yellow. This very successfully keeps us out of chop. So no matter what signals we get in this yellow interval, we do not take them. And then we get another signal here. We would be in at 103.22. I'm sorry, the close is 103.22. We'd be in at 23. The high of the move is 32. It's just a 9-tick trade, but it would hit our first target of 6 ticks. Give us 3 more. We'd be 1 tick away from our second target. But right here on this trend, the system gives us 3 system entries that meet our entry criteria. We must be above the 50, must be above the 15, and the right line trend line must be green. Here, here, and here. We know that these are mini pullbacks into a bigger trend and that the 3 line indicator may be against us, but that does not matter. Now I'm going to introduce you to another indicator. It's a very, very novel indicator. And I don't know of any other indicator like it that's available on the commercial market. Now this makes an assessment of market structure for you. You still have to do your 10% component of structure analysis. There's always a 10% visual component to every trade, which is why automated trading and robots do so poorly. But this is called our ABC continuation indicator. Now the A is here. It's overwritten by the order flow signal to the upside, which obviously we don't take because we do not take long trades when the trend line is yellow, and we don't take long trades below the 50. So the order flow signal is ignored. But what we do see is a move to the upside. Now then, with buyers in control, sellers come in and they cause a pullback. And the pullback comes with an order flow signal, which shows you that there's a ton of sellers in this candle. And where are they all located? Well, if you remember what I had said, on a short order flow signal, they're all located at the bottom. And then what do we get? We get a C engulfing candle. Buyers come in, and they don't just come in, but they come in strong. And they serve to push the market to the upside. Now the A is printed, the B is printed, and then as this candle forms, the C will flash. Now, you did hear a couple of buzzers, but I'm not a big fan of buzzers, bells, and whistles. I'm more a fan of a candle, of a signal flashing intrabar to give you the heads up that you have a potential trade. Once you see the C candle flashing, the right line range maker is going to tell you where your entry is going to be to the upside, and you're going to have your entry waiting one tick above the close of this candle. And not only by virtue of the additional buyers coming into the trade, but by the sellers getting stopped out, it helps to shove the market into the long direction. Now listen, we're trading, we are the small fries in the market. We are the little people. And we cannot outtrade the institutional players. What we want to be is trading with the institutional players. Now clearly what happened here is some small fries try to turn the market. And it's the institutional players that have driven this market right through them and are now going to stop them out. This is really the object of the game here. We want to catch the small traders in the wrong direction, stop them out, trade with the institutional boys. And unfortunately, what we have to do is we have to take their money. I mean, this is the way that you day trade. Money is not created or destroyed. If we put it in our pockets, it's coming out of someone else's pocket, and it's coming out of these people who tried to turn the market at an inappropriate time. And market structure, market analysis, the ABC indicator showed us that institutional players came in and turned this market up hard. And if we look down here, you can see that we traded with order flow, we traded with momentum, and we traded with stochastic. We were trading with a predominance of buying activity. Stochastic was moving up, and momentum was moving up on all time frames. A trade like this really has even a higher probability than 90% of being successful. This is a tremendous setup and a great trade to the upside. Now I wanted to show you one more ABC entry. Now, when the A is the start of any trend. The trend is defined by any two candles of the same color and of the same color. The A starts to flash and it prints. Here we have these unfortunates, and these are the non-institutional small guys who come in and try to turn the market at a very inappropriate time. Now they're caught. And remember, they're going long, and we have an order flow signal here. And they are engulfed by the big institutional players to the downside. Now, we have met all of our market structure criteria. We're below the 50. We're below our modified 15. The modified 15 is red. And this C engulfs these buyers. And we have a nice trade to the downside. It's an incredibly high probability win. Greater than 90% of these setups are gonna roll for you. Now I've added an additional indicator, and this is the right line power entry. And the power entry is really has logic based on regression analysis. And power entries are taken with market structure always respected. Now let's take a look at this power entry, and these red triangles are short signals for you to go short in the market, again based on regression analysis. So let's take a look at this power entry. Now, obviously, if you took it, it was an incredibly successful signal. Now, again, also, sometimes power entries, because they will come on deep pullbacks, come against some lines of the 3 line. They may be against stochastic. They may be against long-term order flow. But this is really a market structure-based indicator. And market structure in right line dogma is responsible for 80% of the information that you use to take a trade. Now, the fact is, you would have already been short in this move here, because here's your perfect C candle. And you'd have already have this move captured. But if for some reason you got ticked out of the trade here, then the power entry would have put you back in. Now, the important thing about power entries is that you must respect the 50 and you must respect the right line trend line. You cannot take a power entry off of a yellow trend line, and you must be below the 50, obviously, and again below the 15. This is a perfect power entry short. To take you to here. Now here's another power entry. That worked incredibly well, but via our rules, we cannot take it because it comes off of a yellow right line trend line. Even though it was successful, we're going to see successful trades pass us by if they don't adhere to our rules. But we do have an entry here on the C candle further down. So we would be able to capture a smaller part of the move, but via the rules where we do not trade yellow right line trend lines, we could not take this power entry. So now if we move across here, we're going to see we're not able to take quite a few. Now, I can't tell in real time if the right line trend line was red or yellow. It may have been red. If it was red, we had a great power entry down right here. Don't know for sure. Obviously, this is yellow, successful, we can't take it. Let's look for some more power entries that we're permitted to take via right line trading rules. Here's another one. Second here. Well, it's got a signal off of the system that we're looking at. So sorry about that that bell there. Here's a power entry right here. Trend line is red, below the 50, below the 15. It's not a huge trade, but we'll take a single or a double any day. And we have a nice small winner here. This power entry we can't take in our conservative strategy. Later on, I will introduce you in later videos to some of our advanced strategies. But based on the rules that I have provided you, where you have to be below the 15 and below the 50, this is not an acceptable entry. Okay. Now, these entries are all coming at, this is Sunday, and these are all coming on a Sunday where we're not going to be trading. I mean, there's no volume. If you look at the volume line here, there is no volume. So, we don't trade on a Sunday evening, nor take signals on Sunday evenings either. But let's look at a couple of other power entries. Here's another one. Well, actually, this is an order flow and a power entry signal. Successful. Now, we do not trade this. It's on a yellow trend line. We do not trade this power entry. It's on a yellow trend line. We do trade this one. And you can see, by adhering to market structure rules, we get an enormous number of successful power entries. And these can really run for us. And oftentimes, because they are pullbacks, the three-line indicator, they're not trend trades. These are pullback trades. And pullback trades may come against the three-line indicator. But as long as we adhere to market structure, we're below the 50 and below the 15, and the right line trend line is red, we can take a power entry short. Same thing is true long. We've got to be above the 50, above the 15, and the right line trend line has got to be blue. Now, the last of our indicators is our right line momentum entry. And this is now the momentum entry are these X's. Now, as many time frames as the three-line indicator assimilates, the momentum entry actually assimilates even more time frames. This tells you when momentum is with you on many, many time frames. So when you get a momentum signal, you know that momentum is with you really across the board. For the 8 range that I trade, it is also with me on the 13, the 18, and the 21 range chart. So that's a tremendous amount of information to tell me that the market is down on multiple time frames. Now, this is a trade that I showed you earlier. And actually, the entry was here. On this candle, on a three-line indicator signal. But if you didn't catch it, you got a momentum signal right here for another opportunity to catch this trade to the short side. And down we go. Now, the one thing that we do not use the momentum entries for, well, let me put it this way. I think it's a little better way of, every single long move to the downside or upside will eventually signal, give you a momentum signal. Eventually, if the market moves far enough, momentum is going to turn in your direction on multiple time frames. It's simply a given. What we want to do is take a momentum entry always with respect to market structure, because that is the key to successful trading. We must trade with the market and respect market structure. So the momentum entries that I really, we're getting all kinds of good signals here. Here's a power entry, successful. Here's a momentum signal that's successful. Here's another momentum signal and a 3-line that's successful. This is not one that I had showed you before. But the momentum entries that I really like, and I'm going to show them to you. Very conservative momentum entries. And if you're in the room, you're going to see that I'm an extremely conservative trader. And this is why it's hard for me to find a really good momentum entry that I like. But let's see here. You can see here, if you just simply chase the market down and take the momentum signal as evidence that the market will continue down, whoops, you're going to get beaten up. It's not a chase indicator. It's an indicator that you use in the appropriate place and at the appropriate time. And here are two places where we've got great momentum entries. Here and here. And in a sense, it's almost like we have momentum price action divergence. Because what's happening, and after a while, I'm telling you, all of these trades are going to become second nature to you. They may seem like a lot of information given to you in a short period of time, because it is. But eventually, this is going to become very simple. And what happens here? Whoops. What happens here is that price action starts to move horizontally. And the best momentum signals, short, come after a long candle. And it's really almost like there's price action momentum divergence. Price action starts to move sideways and into the modified 15, which is red and pushing down hard. And all of a sudden, right off the 15, you get a momentum signal, signifying momentum is now turned down on a huge number of time frames. You're not chasing price action. Price action is actually coming to you. You're short one tick below the close of the candle, and bam, down you go. Very conservative trade, very high probability win. Now the same thing happens here. Price starts to move laterally, and it starts to move towards the 15. And all of a sudden, we're not chasing momentum, we're not chasing price action to the downside. price is actually coming to us. It's moving laterally. We have a green candle, an up candle. Then the down candle triggers the momentum signal. And down we go. Two great momentum signals in a row. Very conservative trades. We are not tracing price action. We're letting price action come to us. We're letting it move laterally on a green candle, signal a momentum entry to the downside, and down we go. Now, to talk briefly about money management, on momentum markets like crude oil, gold, the Russell, I recommend, if possible, you trade 4 lots. So optimally, you can trade 4 contracts. If you can't, it's okay. But this is still going to give you a good, firm foundation for how to set up your NinjaTrader Superdome. Now, if you can trade 4 contracts, you're going to take 2 contracts off at target 1, and target 1 is 6 ticks. You're going to take a contract off at target 2, which is 10 ticks. And then 1 contract is off on a 10-tick trailing stop. And that 10-tick trailing stop engages when your first target is hit. Now, if you're not trading momentum markets, you're trading rotational markets like the ES, like treasury notes or bonds. Again, I recommend 4 lots. Here you're going to take 2 contracts off at target 1, which is 3 ticks. A contract off at target 2, which is 5 ticks. And then you're going to take your last contract off on a 2-tick trailing stop. Now, in the not too distant future, I'm going to be holding a seminar for everybody who has purchased the software. It's going to be free. I'm going to find out the best time that's most convenient time for all of you who currently own the software. We can hold it on a weeknight at 4:30, or we can hold it on a Saturday morning. But I want to give everyone the opportunity who owns the software and is currently learning how to use the software, an opportunity to ask questions. Now, we do have one program that just provides for video. There's video tutorials. We also have 2 programs that one has group mentorship and one personal mentorship. But either way, all of you will be invited to this seminar. So you'll all not only have the opportunity to learn more, but also to interact with each other, find out where everybody else is, and find out where the sticking points are. If you trade the system conservatively, you should be very close to 90% of your entries being successful. Now that means we trade a very specific system, not a sensitive system. The market's going to make big moves that we can't participate in because it doesn't adhere to our market structure rules, or it trades against the 3-line indicator, or we don't get a power entry or a momentum entry, or we don't get a C candle. Parabolic moves are seen in crude oil all the time. The market will just fire up 2 or 3 or 4 points, and we will get no signal. But we do not cry over it. If the market moves and we're not in it, and we don't take a loss on it, it doesn't matter. The amount of winners you take is unimportant compared to the number of losers you take. That is what is going to make or break you as a professional day trader. It's the number of bad trades you enter. And the object of our trading rules and our indicator system is to minimize your bad trades or your losing trades to 1 in 10. We will be back to you very shortly with the with our seminar date. You may have to listen to this video more than once. All the information is here, and if you have any questions, you're welcome to call our office at any time.